In 2005, a doctor with one glass eye and zero Wall Street experience bet against the entire American housing market. He made his investors over $700 million. And almost nobody believed him until the world fell apart. His name is Michael Burry. You probably know him from the movie The Big Short. Christian Bale played him in headphones, drumming on his desk while everyone called him crazy. But the real story is a lot weirder than Hollywood made it look. This is a man who taught himself investing through online message boards. A medical resident by training. A self-described loner. And one of the most disciplined value investors alive today. By the end of this video, you'll understand exactly how he saw the crash coming, why nobody listened, and what his process can teach you about thinking for yourself in a market built on consensus. Michael Burry was never supposed to be on Wall Street. He earned his MD at Vanderbilt and started a pathology residency at Stanford Hospital. But every night, after 14-hour hospital shifts, he posted stock analysis on a message board called Silicon Investor. His writing was so detailed, so rigorous, that established hedge fund managers started emailing him asking for advice. Joel Greenblatt, a legendary value investor, wired him $1 million in seed money. White Mountains Insurance followed. By the end of 2000, Burry had quit medicine and launched Scion Capital. From November 2000 to June 2008, Scion delivered a net return of 489%. The S&P 500 over that same period? Just under 3%. But what made Burry different wasn't the returns. It was the process. He didn't network. He didn't watch CNBC. He read 10K filings, obsessively. And in 2005, that obsession would change everything. Most people heard about subprime mortgages in 2008, after the world had already broken. Burry started reading the underlying loan documents in 2005. He noticed something the entire industry was ignoring. Mortgage lenders were giving million-dollar loans to people with no income, no jobs, and no assets, known in the industry as ninja loans. Adjustable-rate mortgages were set to reset between 2007 and 2008, at much higher rates. He calculated that when those resets hit, millions of homeowners would default. And the bonds backing those mortgages, rated AAA by every major rating agency, would collapse. So he did something nobody had done before. He went to Goldman Sachs, Deutsche Bank, and Morgan Stanley, and asked them to invent a new product. Credit default swaps on subprime mortgage bonds. The banks thought he was insane. They wrote the contracts gladly, convinced they'd never pay out. By 2007, Burry held over $1 billion in CDS positions, betting against bonds that everyone else considered as safe as treasury notes. And then, he had to wait. Here's the part the movie barely captured. Burry was right. But being right early feels exactly like being wrong. For nearly 2 years, his investors watched him bleed money on premiums for insurance contracts that paid nothing. Investors threatened lawsuits. They demanded their money back. Some called him a fraud. Burry suspended redemptions on the CDS positions. He stopped returning emails. He locked himself in his office and held the trade. Imagine the conviction that takes. Imagine watching your largest investors call you a liar, while you stare at data telling you the entire global financial system is about to collapse. By the end of 2008, his analysis was vindicated. Lehman Brothers fell. Bear Stearns fell. AIG had to be bailed out by the US government. And those CDS contracts? They paid out roughly $700 million to Burry's investors, and about $100 million personally to Burry himself. Then, in a move that surprised everyone, he closed the fund. After the crash, Burry didn't celebrate. He didn't write a book. He didn't go on TV. He returned the money. He shut down Scion Capital. And he disappeared for years. He bought farmland. He bought water rights. He studied agriculture and resource scarcity. Years later, he reopened as Scion Asset Management. And he kept doing what he'd always done. Reading the filings nobody else would read. He warned about index fund inflows in 2019, when everyone said passive investing was unstoppable. He bought GameStop in 2019, before it became a meme stock. He shorted Tesla. He shorted ARK Invest. Sometimes he was early. Sometimes he was wrong. In January 2023, he tweeted a single word, "sell," and the market briefly shuddered. A few months later, he admitted publicly that he'd been wrong about that call. That admission is the most important thing about Michael Burry. He doesn't pretend to be infallible. He's wrong all the time. What makes him different is that he keeps doing the work, keeps reading the data, and keeps placing bets based on evidence, not consensus. Here's what Burry's story really teaches us. It's not about shorting. It's not about predicting crashes. It's about this: most investors lose money because they outsource their thinking. They trust ratings agencies. They trust headlines. They trust the crowd. Burry built his fortune by trusting only one thing: the actual numbers in the actual documents. He read what nobody else would read. He thought what nobody else would think. And he held positions long after his own investors begged him to quit. That kind of conviction can't be borrowed. You have to earn it, one filing at a time. So here's my question for you: what's the last annual report you actually read cover to cover? Drop the company name in the comments. I want to know what you're really studying, not what you're hearing about on Twitter. And if this changed how you think about doing your own research, hit subscribe. Tomorrow we're looking at a very different kind of investor, someone who built a fortune by ignoring the market entirely. You won't want to miss it.